Welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, here's this week's market wrap with commentary and analysis from the low-cost precious metals dealer voted best in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. As volatility shook Wall Street again this week, gold and silver markets advanced strongly into Thursday morning trading before encountering some mild selling. As of this Friday morning recording, gold shows a weekly gain of 1.1% to bring spot prices to $1,956 an ounce. Over the past month, gold has traded in a range with support around $1,900. Bulls have made a couple unsuccessful attempts to retake and hold above the $2,000 level following the sharp plunge below it on August 11th. We will likely see a more decisive move in the gold market one way or the other in the days ahead. Turning to silver, prices currently come in at $27 an ounce after gaining 0.9% this week. Platinum is showing relative strength, up 3.6% for the week to trade at $950. Its sister metal palladium is looking strong here today and now shows a 1.9% weekly gain to check in at $2,403 per ounce. The near-term outlook for precious metals markets may be determined by where the U.S. dollar index heads next. It has been basing out since August after trending lower earlier in the summer. The Federal Reserve note appreciated modestly against foreign currencies ahead of the European Central Bank's policy meeting on Thursday. The ECB made no changes to interest rates, leaving its deposit rate in negative territory at negative 0.5%. Like the U.S. Federal Reserve, the ECB is trying to stimulate inflation. Which central bank will be most successful at depreciating their currency is a matter of speculation for forex traders. Both currencies stand to lose value over time when measured against real assets, including precious metals. Billionaire hedge fund manager Stanley Druckenmiller is worried that the U.S. dollar will lose purchasing power much more rapidly than the 2% average the Fed is currently telegraphing. Druckenmiller sounded off this week and said he sees inflation rates likely rising to 5% or perhaps even 10%.
I think the merging of the Fed and the Treasury, which is effectively what's happening during COVID, sets a precedent that, well, we've never seen since the Fed got their independence. And it's obviously creating a massive raging mania in financial assets. For the first time in a long time, I'm actually worried about inflation because we actually have the chairman of the Federal Reserve with a $3.5 trillion deficit lobbying Congress to do more spending and guaranteeing those of us on Wall Street that he'll underwrite it.
Even though the stock market has been pumped up with Fed stimulus, the government's inflation gauges haven't been reflected much in the way of broad price increases in recent years. An upsurge would catch most investors by surprise. The latest Consumer Price Index report came out today and shows price inflation beginning to turn around after a short-lived deflation scare this spring. At one point, crude oil prices actually fell below zero to assign a negative price per barrel. Oil, copper, and precious metals prices have since risen dramatically off their lows for the year. However, commodity markets took a bit of a hit this week as shares on Wall Street slid and the U.S. dollar strengthened against foreign currencies. In an environment of rising inflation, investors should expect hard assets to begin to decouple from stocks and other paper assets that are priced for low inflation and ultra-low interest rates. Some sectors of the economy may benefit from inflation. Others that are more discretionary and are unable to pass on rising costs to struggling consumers will suffer. Rising inflation would be a disaster for holders of bonds, defined benefit pensions, and annuities. What are conventionally thought of as the most conservative investments would have the worst prospects for staying ahead of inflation. Assets that the financial industry urges investors to avoid as being too risky would be among the only safe havens in the event of double-digit inflation. In such an environment, the highest quality assets to hold would be physical gold and silver. At some point, they may become too difficult or too expensive to obtain. At some point, inflation fears may peak and subside. At some point, stocks or bonds may represent better value. Every asset class has its time to shine. Prudence dictates being well diversified at all times given the unpredictable nature of markets. Nobody knows when the next pandemic or terrorist attack will hit. It's been 19 years now since September 11, 2001. Thankfully, nothing on that scale has occurred since then. But geopolitical risks are on the rise with Iran, Russia, China, and other adversaries. Nobody knows what the upcoming election will bring, except that whoever wins will inherit a record budget deficit. Whoever wins will depend on the Fed to keep suppressing rates, buying bonds, and expanding the money supply. If investors like Stan Druckenmiller are right, then either the Trump or Biden-Harris administration will have a serious inflation problem on its hands. The early stage of a rising inflation trend is a crucial time in particular to make sure your investment portfolio includes an ample allocation to precious metals. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.